Hey everybody, what is a SAR, or Suspicious Activity Report? In financial regulations, a SAR, or a Suspicious Activity Report, and we also have Suspicious Transaction Reports, are reports that are made by a financial institution about a suspicious or potentially suspicious activity. Now, the criteria to decide when a report must be made, it really does vary from country to country. And most countries have some type of SARs reporting requirement. But generally, it is for any financial transaction that does not make sense to the financial institution, or is unusual for that particular client, or appears to be done for the purpose of hiding or obstructing another, possibly separate transaction. Now, the report is filed with FinCEN. That's the Financial Crimes Enforcement Agency, which is designed to collect and analyze transactions and then report these to the relevant law enforcement agencies. Frontline staff in the financial institution has the responsibility to identify transactions that may be suspicious. And these are reported to a designated person that is responsible for the suspicious transaction. The financial institution is not allowed to inform the client or parties involved in the transaction that a SAR has been placed or filed. For example, here in the United States, suspicious transaction reports and suspicious activity reports are to be reported via the Financial Crimes Enforcement Network, FinCEN, an agency of the United States Department of Treasury. We have a video on them if you want to learn more. In Australia, the SAR must be reported to the Australian Transaction Reports and Analysis Centre, an Australian government agency. Now, most countries have laws that require financial institutions to report suspicious activity transactions and will have a designated agency to receive them. The agency to which a report is required to be filed for a given country is typically part of the law enforcement or financial regulatory department of that country. SARs include detailed information about the transaction that appear to be suspicious. The goal of the SAR filing is to help the government identify individuals, groups, and organizations that could be involved in fraud, like even terrorist financing, possibly money laundering, or other financial related crimes. The purpose of a suspicious activity report is to really be able to detect and report known or suspected violations of suspicious activity that is observed by the financial institution, which of course is subject to regulations like the Bank Secrecy Act or AML, anti-money laundering. Now, in many cases, SARs have been instrumental in enabling law enforcement to initiate or supplement major money laundering or terrorist financing investigations or other criminal cases. Now, information provided in SAR forms also presents FinCEN with a method of identifying emerging trends and patterns that could be associated with financial crimes. The information about those trends and patterns is vital to law enforcement agencies and provides valuable feedback to the financial institution. Here in the United States, FinCEN requires that a SAR be filed by a financial institution when the financial institution suspects insider abuse by an employee, where there's violations of law over $5,000, where a subject can be identified, violations of law aggregating over $25,000, regardless of a potential subject, transactions aggregating $5,000 or more that involve potential money laundering or violations of the Bank Secrecy Act, computer intrusion, or when a financial institution knows that a customer is operating as an unlicensed money service bureau. Each SAR must be filed within 30 days of the date of the initial determination for the necessity of filing the report, and an extension of 30 days can be obtained if the identity of the person conducting the suspicious activity report is not known. But at no time, however, should the filing of a SAR be delayed longer than 60 days. The Bank Secrecy Act specifies that each firm must maintain records of its SARs for a period of 5 years. The report can start with any employee in the financial institution. The employees are generally trained to be alert for suspicious activity, such as situations where people are trying to wire money out of the country without identification, or activity by someone with no job who starts depositing a large amount of cash into an account. That's weird. Employees are trained to communicate their suspicions up their chain of command, where further decisions are made about whether to file a report or not. When in doubt, file the report. Many different types of finance-related industries are actually required to file SARs too. We see it here in the banking industry, so banks and credit unions, they have to do it. But we also see it with securities and future dealers like stockbrokers, mutual fund brokers. We also know that it takes place with money service bureaus like check cashing services or currency exchange bureaus. And we also see it with casinos, we see it with card club dealers, those who deal in precious metals and gems, those that deal with insurance companies and mortgage companies as well. So folks, that really is a breakdown of SARs. If you want to learn more, if you've got any comments, please, you can email me, kevin@paymentsprofessor.com. You can message me. You can also leave a comment. And if you like this video, please like the video. Thank you for watching.